Hello, and welcome to BeLoanReady. What product and term should I choose? Today, let's take a look at how to frame up what the right product and mortgage term is for your situation. We don't choose these things for you. That would be undemocratic. As always, we're here to provide you with solid information so you can make the choice that is best for you. There are different types of mortgage loan products, such as conventional, FHA, and VA, but we won't be discussing that here. For that information, please see our other video, Which Product is Best for Me? To start the conversation, let's talk about fixed rate options and adjustable rate options. With all mortgage loan options, much of the decision-making process comes down to risk and long-term financial/housing goals. Fixed rate mortgages maintain the same interest rate and monthly payment for the term of the loan. Adjustable rate mortgages generally offer a lower initial rate, but they are susceptible to changing interest rates and monthly payments. And for more on ARM loans, see our video on ARM loan payment adjustments. Fixed rate mortgages. They offer peace of mind from mortgage payment changes throughout the term and allow you to more accurately budget your mortgage expenses. They also offer a wide variety of terms as options. For example, 10-year, 15-year, 20-year, 30-year, and so on. Adjustable rate mortgages. Generally, these offer lower initial interest rates for the initial fixed rate period. However, this is a riskier product when the loan enters its adjustment period. Payments and rates will change. Typically, ARM loans are amortized at a 30-year term, providing lower payments during the fixed period. Whether you choose a fixed rate or an ARM will depend on your unique situation. Some of those situations might be, if you plan to only own your home for a few years, then maybe an ARM makes sense because you'll move or sell before the loan starts adjusting. Or, if you plan to stay in your home for many years, then perhaps the stability of a fixed rate mortgage makes more sense. Or, if you're on a limited budget, then perhaps a fixed rate is a good option. If you do choose a fixed rate mortgage, you'll need to ask yourself, what term is best? We'll compare two so you get the right idea about how to frame up the options. Let's take a look at the two most common terms, the 30-year and the 15-year options. But don't worry, this isn't that complicated. The 30-year is great because your monthly payments get spread over 30 years, but you do pay a lot more in interest to the lender over that period of 30 years. If you're a first-time homebuyer or on a tight budget, this may be a popular choice. The 15-year term can also be a great choice. You tackle that principal balance with some serious force compared to the 30-year term, and you don't pay near as much interest to a lender. The big downside is that at 15 years, you gotta give up one of your kids. I know, it's brutal, but hey, you signed the papers. But seriously, the big downside is that at 15 years, your monthly payment will be considerably higher than the 30-year term. Obviously, there are other terms, like a 10, 20, and 25 years. But the pros and cons are pretty similar to the discussion between the 15 and the 30-year. Maybe a 20-year is that bowl of porridge that is just right. Well, that's all for this one, Goldilocks. We hope you found this video helpful. But should you need assistance at any point, don't be afraid to hit the help button, and a mortgage mentor will be right there to assist you. Thanks so much for watching, and we'll see you in the next video.